session, we shall continue to explore the nature of double entry accounting. For most transactions, you only need to remember two very simple rules and then apply these to the transactions you are entering. In our first session, you learned that transactions are entered as debits and credits to the accounts. When a transaction is entered, it will affect the accounting equation. Since that equation has to remain in balance, then each transaction that is entered must also be entered in a way that continues the balance. The debits for a transaction will be equal to the credits. The rule is that debits will equal credits for each transaction. Remember that. Debits equal credits. The second rule will help you to determine whether an account will have a debit or credit entry for any particular transaction. Each account has a natural balance. The natural balance being the entry that would increase the account. The natural balance for a sales account will be the entry that increases sales. The natural balance for an expense account will be an entry that increases expenses. Knowing the natural balances will help you make the entries. So we have to start somewhere. Remember that debtors owe money and represent an asset, and that debits are the entries for debtors which are made in the left column. An asset account then is increased by a debit. The first asset account that you usually meet in accounting is the cash account. A debit entry will increase the cash account. When an owner invests capital, then the entry must be a credit in order to keep the balance. The natural balance for an equity account must be a credit. We shall start with asset accounts. The natural balance, as we have just indicated, is on the debit side. Debit entries will always increase asset accounts and credit entries will reduce the account. Asset accounts include cash accounts. The most typical is often called the cash account. But other asset accounts include premises, plant, equipment, and the account for debtors, which these days is referred to as accounts receivable. When we deposit money in the bank account, we shall debit the account. When we acquire an asset, such as a motor vehicle, we shall debit a vehicles account. When we acquire goods for resale, we shall debit the inventory account. When we make payments to reduce assets, we credit the bank account. To record when goods have been taken from inventory and sold, we shall credit the inventory account. When we receive payments from debtors to reduce the amount owed to us, we shall credit the accounts receivable. Just as asset accounts record what we have, what we own, or what we are owed, so there will be another corresponding set of accounts that records all that we owe. These accounts are known as liability accounts. The natural balance of these accounts will be the opposite to that of asset accounts. The natural balance will be a credit. Any entries that increase the amount we owe are credits, and any that reduce the amount we owe must be debits. What sort of accounts are included here? If we take out a loan, we owe money, so loan accounts are liability accounts. When we buy goods on credit, we record the amount owed in accounts payable, so this must also be a liability account. Purchases on credit increase liability. Payments made to creditors decrease the liability. A special set of accounts records the amount that owners have invested in a business. If the business is a sole proprietorship or partnership, then these accounts are usually referred to as capital accounts. If the business is a corporation, then the account is referred to as a common stock account. When first studying accounts, it helps to think of the investment as what the business owes as an entity to the owners. Thus, equity accounts can be seen as a special form of liability account. Their rules are similar. An investment is recorded as a credit. For a sole proprietor, the account is a capital account, where investments are then recorded as credits. An owner will also take money from the business, usually for personal use. This reduces their interest in the business, and so the withdrawals will be recorded as debits. Since withdrawals are recorded in a separate account, the natural balance of a withdrawals account will be a debit. The objective of a business is to make sales, whether of goods, raw materials, services, or a mixture of any of these. The accounts that record the inflow from sales are referred to as revenue accounts. If a sale is made and cash is received, then the asset of cash is debited. It follows that the sales entry must be on the opposite side to maintain the balance. The natural balance of revenue accounts will be credits. The first account that you meet as a revenue account is usually called sales. There may be any number of sales accounts depending on how a business wishes to hold information. Sales accounts can be distinguished by area or by type. If a business is receiving rent for property or land, this income would also be recorded in a revenue account. If a business receives money from other investments, such as interest or dividends, these are also revenue accounts. Sales increase revenues, and so sales will be recorded as credits. What will happen if goods are returned? If the return is accepted, then it will have reduced the revenue from sales. A return is therefore regarded as a debit. There is always a cost to running a business. The cost may be referred to as a business overhead. We record the costs of running the business in a group of accounts that we call expense accounts. Just as sales represent inflows into the business, so expenses will represent outflows. These outflows are recorded as debits, so the natural balance of an expense account is a debit. What are some typical expenses? The use of utilities such as electricity, water and gas, the use of a telephone, the use of office materials, and so on. Should any materials be returned and refunds obtained, then the business would not have incurred that expense. Refunds and returns will therefore be regarded as credits. You should try and learn the natural balances for the types of accounts: assets, liabilities, equity, revenue and expenses. This will assist you greatly when analysing transactions for entry. This ends our second session on double entry. Thank you for listening and for watching.